At this point in the show, we are pleased to welcome Callum Thomas from Top Down Charts, and he's our first guest from New Zealand. So it's with a big hello that we say to you, Callum, but it's actually not an afternoon for you. It's actually a morning. It's Saturday morning when you're in New Zealand.
Yes, exactly. Yeah, the sun is just coming up right now, and yep, the birds are starting to sing, so ready
Well,
to go.
you're a real trooper to come on and get up Saturday morning and talk markets with us. We really appreciate it. So, what's on your mind? What are you thinking? This is Friday after in Toronto. Here it is Friday after the unemployment number. There's been lots of action, but what do you see in the markets?
Yeah, I well, there's a lot of things going on. I think we've got my slides up there. So this is the my weekly report, and it's we've kind of caught it on a good week because the topics that I've put in this week. Well, I did kind of know that I was going to be talking today, but they capture a lot of I think some of the big moving parts, and particularly relevant to what's sort of gone on in the last sort of 48 hours. So, I mean, I think if we start off there with that PMI pulse, so we jump over to page 3. So it's not a pretty picture. Um, I'm still kind of like in the camp that says this is a passing growth scare. But you look at the PMIs that we've got here, and it's basically as bad as it gets, outside of a major recession. I think that the first chart there shows US PMI catching down to global ex-US. I think that one's really key for the Fed. Payrolls is whatever it's going to be, but um, when they were talking at the press conference, a few weeks ago, he, Powell mentioned the global aspect, and it's pretty much, that chart there captures that in a nutshell. Um, you know, the US can't go it alone, and
Right. I'm gonna. It's Kev here, Callum. The
yeah,
actual global U.S. Ex-U.S. is actually below 50, which is the point of expansion, and it's actually moved into a contractionary phase. Is that correct?
mm, exactly. Yeah, so it's not a pretty picture. And so I think that chart pretty much cements the rate cut, and we'll talk a little bit more about that in a second. But I was kind of reflecting on these charts, and because you always, the data's going to be what it's going to be, but you have to kind of take this, apply a level of pragmatism. Um, and so, a couple of things that I'd mention about these, yes, it's looking pretty awful, but first of all, these are surveyed data, so there's always going to be an element of sentiment in it. So, potentially the sentiment aspect, all these scary headlines that we've had over the last, well, probably 18 months really, but all this sort of scary flow of headlines, you know, that have the possibility of sort of making the survey respondents a little bit more pessimistic than perhaps the reality is. The other aspect is the sort of upside down, counterintuitive statement that it could be just that it's so bad that it's good. Um, yeah, I think that's quite a useful little statement to have, just sitting in the back of your mind, because there's a lot of indicators, particularly sentiment kind of indicators, but even cycle indicators like this that, when they're really bad, that's not always actually the best time to get bearish. Sometimes it's actually a good thing because, well, one, it means that the central banks are going to start paying a little bit more attention, and the other
Right.
thing is that the buying tends to be better when these indicators are at their worst rather than at their best. I mean, when those two peaked, it was almost, you know, exactly in line with where global equities peaked. So yeah, there's definitely a sentiment element to that.
Yeah. This is Patrick here. What I see here, like if you go back to 2016 when the PMIs were last down near the 50 line, and that's actually where the Jamie Dimon bottom occurred and the whole market came roaring back. But there was truly this kind of like a reflation impulse that came that was really driven by central banks. Do you think that it just a rate cut by the Fed, one or two, is going to be sufficient to kind of reliquidate? I mean, I would think that we would need to see policy change in like China and other places like this to really get another big upturn started. Am I out of line with that statement? What's your thinking?
Um, if we jump to page 6, I've kind of got something I've already prepared for this.
Oh, perfect.
All right, so I think this chart on the left here kind of says it all. I'll just walk you through it. So the red bars there are the count, the monthly count of rate hikes, and the green bars are the monthly count of rate cuts. So this is across basically all the major central banks and across developed and emerging markets. And well, before answering that question, it's quite interesting to just take stock of where we've been. So if you look in 2018, there was this period of I think about 9 months where there was basically no rate cuts and a whole slew of rate hikes, like just relentless rate hikes. And in hindsight, whether you want to call it a policy mistake or whether you want to say that in this age of higher leverage, interest rate sensitivity is just that much higher that you know we couldn't actually take that amount of rate hikes. Whatever way you want to pull it, we're now turning the corner on that. So if the Fed does go ahead and cut once or twice, it's not the only one doing it. It's going to be one of many. Um, and if you look at emerging markets, they're turning the corner on policy now. So I call it the big global monetary policy pivot. And I think that that's going to be one of the key themes for the second half of the year, and probably into 2020 indeed as well.
So you think that the monetary policy is already pivoted, and the U.S. is almost the last one to kind of pull the trigger on actual cuts, and we accelerate from here, like we get more going forward? Is that what you're thinking?
Yeah, I think so. I mean, it's how many rate cuts the Fed does is kind of one of those um, questions that if we knew the answer, then we'd know what everything else is going to do. You know, a two or three rate cuts is a scenario where they make the insurance cut and everybody else is cutting as well, and that sort of that already kind of fixes it or puts it back on track. And then the other scenarios where they have to cut all the way to zero, which is obviously where they were too late to cut, and or the cuts weren't enough to turn it around. But I think if you jump onto the next page, there's yeah. So the one on the left there, the red line is the weighted average monetary policy rate across developed economies, but I've substituted in this thing called a shadow policy rate. So that's basically the headline monetary policy rate adjusted for the impact of quantitative easing.
Okay.
So there's a researcher actually here in New Zealand at the central bank who invented this sort of analytical technique, and as you can see there, it's actually already come down 120 basis points. So quite a substantial shift there. Like it's almost on par with the kind of easing that we saw in the wake of the 2015-16 corrections. So I think that this is if you want to look through the all the bad news that definitely is out there, and begin to construct a bullish story, I think that this is probably the one of the key foundations for that.
Okay, so if that's the case, what do you think is going to happen to treasuries? Like, how does this play out in terms of the U.S. Treasury market? Because to some extent, is this not already priced into the bond market?
Yeah, that's a good question. I think if we just thinking what chart's the best one to look at for this. So Probably if we jump all the way down to page 12. Actually, maybe we just briefly jump down to page 14 because I just want to touch on the US dollar because it's probably worth taking a quick detour down that path before we come back to treasuries. And my reasoning there is that so if we so if we look at the chart on the right there, the the transition from rate hikes to cuts has been a pretty good catalyst historically for to put a stop to a US dollar bull market, or even kick off a US dollar bear market. And then you think about a few other sort of background features with the US dollar, like positioning still fairly crowded to the long side. I think overall market sentiment's probably sort of somewhat split on the US dollar. So I don't want to necessarily say that everybody's expecting a stronger dollar, but there's definitely a lot of people in that camp. And then you look at the chart there on the left, we've got here the red line. I better explain it because it's a little bit tricky. It's currency market breadth. So it's you're taking those pretty standard market breadth concepts that we know from the stock market and applying it to the currency market. And it's a blend of 50-day moving average breadth, 200-day moving average breadth, and 52-week new highs minus new lows. And the key thing that stands out to me is this interesting little pattern where you have a higher high on the US dollar index and a lower high on this composite breadth indicator. And that has shown up at some pretty major turning points, major peaks, but also some sort of minor peaks. But, speaking back to sort of the global aspect, and policy and financial conditions, if we do actually get the US dollar rolling over, that's going to be quite a tailwind for global risk assets, and it does definitely have that financial conditions easing impact.
Right. And so how does that translate to treasuries? If we do get a kind of a risk on move, do you foresee, some problems in treasuries?
Yep. So probably the best first stop there is page 11. And what we've got here is basically two ways of showing how treasuries move with the global economic pulse. So on the left there, we've got developed markets manufacturing PMI against the US 10-year bond yield. And on the right there, that's basically the rate of change or the diffusion of global business and consumer confidence against the year-on-year change in the 10-year bond yield. So essentially, at the moment, you look at these two charts and you say, well, treasuries are pretty much where they should be because we've seen a clear deterioration, at least in the surveys, and they kind of should be low, and so figuring out what the impact of central bank policy is going to be on treasuries or indeed global government bonds comes down again to the question of will the policy stimulus work? Will easier financial conditions work? And it usually does. And if it does, then the red line on the left hand chart goes up, and bond yields probably go up with it. And the same thing on the right. And then probably just briefly on the next page, page 12. This is coming from a situation where, at least on my indicators, US 10-year government bonds are very expensive. One of the most expensive readings on record. And in that top right-hand chart, everybody's wheeling out sort of some version of this chart, the proportion of global government bonds that are having negative yields and all the rest of it. But there's one interesting thing on this chart is, so because it shows you the proportion of countries whose 10-year government bond yield is trading below these various brackets, you can see that in 2012-13 it had this big run up in the proportion of those that were trading below 2%, and then in 2015 it was this big surge in those trading below 1%, and now you're having this big surge in those trading below 0%. And those two previous, the reason I mentioned this is those two previous episodes were kind of, it was it was shortly after those spikes that you saw a bottom in bond yields. So basically, it's a long-winded way of saying that global government bond market looks pretty overbought at this point.
Right. And one of the things that with the global bond markets bid so much, we have kind of investors reaching for the defensives. And I see like the defensive parts of the stock market. And I see you have some interesting charts on cyclicals versus defensive. Why don't you walk us through your thinking there?
Yep, sure. So if we jump down to, why don't we start on page 19 there? So this is probably another one that needs a lot of explanation. So we'll start with perhaps that one on the right there. So this is US cyclicals versus defensives relative earnings ratio. So the average earnings revisions ratio for cyclicals minus the average earnings revisions ratio for defensives. And that's shown against the ISM manufacturing PMI. And surprise, surprise, they're both telling us basically the same thing. But probably the concern here is that you look at the one on the left. So in the red line there, that's showing the cyclicals versus defensives relative performance. And that's been detrended so that it's sort of mean reverting there and, comparable. Basically, we're seeing a bit of a divergence there. And so if we jump back to the previous page, so 18, the chart on the left there, that's just showing how cyclicals trade versus the market, and they were basically responsible for that big new bull market in 2017. And the reason why that's relevant is, the reason why I highlight that is just to really highlight that, if we do see, my sort of optimistic take on the previous slides being wrong, and that cyclicals end up catching down to the weaker PMI, that it is more of a sort of protracted and deeper downturn, then obviously the broader market is going to suffer as a result of that. And probably lastly, just in passing, on page 20 is the global picture, and it's very, very similar picture there as well.
So just to clarify here, Callum, is that are you suggesting that moving away from defensives is your idea? That am I reading that right? How do you position yourself with this data?
Yep. So it's kind of a tricky picture here because you have to basically first of all take a position that says cyclicals are going to catch down to the weaker economic data, or that actually they're just going to hang in there, do their thing, and the economic data is going to catch back up. I mean, to be sort of consistent with what I was talking about previously with the sort of bearish outlook that I'm painting there for treasuries, then obviously things like REITs, utilities, certainly relative to the market, are not going to have a good time when if bond yields head back up.
So would you be positioning more into like higher beta cyclicals then, or do you just stay underweight this and wait it out a little bit with above average cash? How does one position themselves in the portfolio with this?
Yeah, that's a good question. My favorite positions at the moment, and unfortunately I didn't include the charts on these, are global ex-US, emerging markets, and commodities. And so that kind of speaks quite directly to the the policy pivot, and two, the bearish US dollar outlook.
So you foresee a kind of a global reflation most likely happening, and in doing so, you'll see the U.S. dollar go down, and we'll get kind of a traditional EM rally. It's kind of what you're thinking.
Yeah, that's my base case.
Yeah, fair enough. So listen, Callum, it's been great having you. Why don't you tell people where we can find more of your work and what you guys do at Top Down Charts, and where they can kind of find out more about you and your firm?
Yep, so probably the first stop is to follow me on Twitter, so at Callum_Thomas. I think you got that on the screen there. And then the website there, I put the occasional post up there, but you know, for the key thing that I do is basically working with institutional investors, mostly asset allocators. And so what we've actually walked through there is the weekly report that I do. I also do a monthly chart book, and you know, some thoughts on dynamic asset allocation positioning there, and also a markets monitor. And if you jump onto the website, if you think that kind of thing's probably a bit too much for you, you could try out the top 5 charts of the week, which is kind of a new thing that I've just launched recently. That's just a little subscription product. You get basically 5 charts and a bunch of commentary around that, and a key takeaway for each of the charts, which is could be well worth looking into.
Well, Callum, you know what? You've been one of my favorite Twitter one of my favorite Twitter follows for a long time. I really enjoy your charts and you have a lot of surveys you do, and you share a lot of information. So people, make sure you sign up for at Callum_Thomas. Thanks a lot for being with us today, and stick around for the After Hours show where we learn more about Callum, and we bug him a little bit more early in the morning here.